If you own a property in Australia right now, there's a good chance you're sitting on a gold mine and you don't even know it. I'm talking about equity, and it could be the key to building a multi-property portfolio without saving another dollar. I'm Alex G, founder of Kingfisher Finance Group here in Brisbane. We settle over $100 million in loan applications every single year and hold more than 120 five-star Google reviews. Over the last 5 years, I've specialized in helping investors and business owners unlock equity they didn't even know they had, and use it to build portfolios worth millions. But here's what most people get wrong about equity. They think having it means they can automatically afford more debt. That's not how it works, and that misconception has cost people a lot. So in the next few minutes, I'm going to show you exactly how to use equity in your home to buy multiple properties faster. I'll walk you through the real numbers, show you the common traps that can box you in for years, and give you the exact step-by-step process we use with our clients. So let's dive in. First, let's get clear on what equity actually is. Equity is essentially the difference between your property's value and the level of debt you have on that property currently. So if you have $1 million property and you owe $500,000, you have $500,000 in equity. Simple, right? But there's a catch. You can't access all of that equity. We can only access up to a certain percentage of your property's value. In most cases, that's 80% of what your property is worth. So in that same example, $1 million property, $500,000 debt, we can only access up to $800,000 of that $1 million property. You would only have $300,000 in what we call usable equity. That's the portion we can go back to the bank and release for whatever purpose we choose. Now, when a client comes to me saying, I want to use my equity to buy another property, I ask them 3 specific questions. And if you're thinking about this strategy, you need to answer these honestly. Question 1, what's your long-term plan? Are you trying to build passive income, looking at capital growth? Is this the last property you'll ever buy or the first of several? A lot of people have this vague idea that they want to access equity to buy more property, but they haven't put any rational thought behind it. Without a clear plan, you could end up with the wrong property in the wrong location, structured the wrong way, limiting your ability to buy again in the future. Question 2, what are your expectations around cash flow? Are you hoping to be cash flow positive from this? Expecting rental income to put money in your pocket every week? Because here's the reality for most people. If you're using equity to buy an investment property, it's probably going to cost you money week to week. This is one downside to leveraging equity. We end up with a bigger loan than if we were contributing savings towards a deposit. Question 3, can you actually afford the new debt? This is the big one. Having equity doesn't mean you can afford more debt. Your income still needs to support the new repayments for both the equity loan and the new investment loan. Let me show you what I mean with a real life example. Let's say you're a mum and dad in Brisbane with the property now worth $1.6 million, and you owe $1 million currently on your existing owner-occupied mortgage. Now, in this funding table, what we're presenting is a potential refinance of your owner-occupied debt and a purchase of an investment property at $1 million. So on the left-hand side, we have the refinance scenario, which factors in your existing loan balance plus refinance costs. And on the right-hand side, we have the purchase scenario, which factors in your $1 million purchase plus stamp duty and legal fees. So on a $1 million investment property, we need roughly $1,045,000 to cover our 20% plus costs. What we're able to do is effectively increase the total debt on our owner-occupied property up to $1.245 million and take that $245,000 as our deposit plus costs on the investment, leaving us with that 80% loan at $800,000. As we now look at the product comparison, you'll note we have 3 separate loan splits. We have loan split 1, which will be our owner-occupied refinance of $1 million. We'll have loan split 2, which will be our investment equity release of $245,000. And we'll have loan split 3, which will be our new investment loan against the new property. Loan split 1 for the owner-occupied debt is non-deductible debt. Loan split 2 and 3 on the investment is now tax-deductible debt. And you can see here we have $4,955 a month that we can claim as an interest deduction. Now, even if opting for interest-only loans for both investment splits, your repayments are still going to be roughly $1,140 a week across both loans. On that $1 million property, you might only get $800 a week in rental income. So you're negative $340 a week straight off the bat, even when taking the interest-only option. That's before management fees, repairs, maintenance, and all the ongoing costs of owning an investment property. By tax time, there's a fair chance that property is going to cost you upwards of $500 a week on paper. That's most likely a $26,000 loss over the year. Now, if you're in the highest tax bracket, paying 47% tax, that $26,000 deduction might get you $12,000 back at tax time. This is called negative gearing. But here's the key. You still need the cash flow to cover that $500 a week until tax time comes around. As you are now starting to realize, equity strategies aren't for everyone. So there are generally 3 scenarios when I actively recommend clients don't use their equity. First, if you can't comfortably manage the cash flow impact, even if the bank says you can afford it on paper, we're not recommending you take maximum exposure. You need to feel comfortable with that new obligation hanging over your head. Second, if your position isn't stable. For example, you know you'll be upgrading the home in the next few years. In that case, pulling equity or considering debt recycling doesn't make sense. Why? Because when you sell, you need to repay all debt, including the equity loan, which will leave you with less sale proceeds to go and upgrade. By having less sale proceeds, you would also need to borrow more owner-occupied debt on the next purchase, which may limit your options from a borrowing perspective. Also, by selling and repaying the equity loan, you in turn lose all tax deductibility benefits on that loan split moving into the future. And lastly, if you don't have adequate buffers in place, you need to be able to handle vacancy periods, unexpected repairs, and potential rate rises. The key is being honest about your situation and your risk tolerance. Now, if you've worked through the numbers, answered those earlier questions honestly, and you're confident this strategy fits your goals and risk tolerance, let me walk you through our exact process. Step 1, property valuation. Across our panel of lenders, we can instantly request multiple valuations on the same property. Within 5 to 10 minutes, we'll usually have 3 to 4 different figures back, giving us a clearer picture of how the banks view your property and which lender will give you the highest usable equity. If we need to, we can also upgrade these online desktop valuations to full valuations, particularly if you've made improvements to the property since purchasing. Step 2, calculate usable equity. Once we've determined the most favorable valuation amount, we calculate how much equity you actually have access to. Remember, that's usually 80% of the property value minus what you owe. Step 3, run your serviceability. Exactly when you first applied for your home loan, we look at your income and run borrowing capacity across multiple lenders. Because as I mentioned earlier, without the servicing, sometimes it doesn't make sense to pull equity if you can't actually afford the repayments. Sometimes the best play is to release equity with a first-tier lender, then use a different bank for the actual investment purchase, where we can often push borrowing capacity further. This is where second and third tier lenders can be more flexible, and when used strategically, they open the door to that next purchase. Step 4, structure the loans properly. This is where most people get it wrong. Your owner-occupied debt stays as its own split. The equity release becomes a completely separate investment loan split, and the new investment property has its own standalone loan. We do it this way to keep everything clean. Your home loan remains separate, your equity release is clearly marked as investment debt, and your new purchase floats on its own. That separation gives you clarity moving forward. What we avoid is cross-securitization, where the bank ties multiple properties together under one big loan. On the surface, it looks simple, but in practice, it creates huge problems. For example, if you want to sell one property, the bank can trigger a full reassessment. They'll often order new valuations across the whole portfolio. Worst case, they can even direct you to use the sale proceeds to pay down more of the remaining debt, instead of freeing up cash for your next move. It's like having two boats tied together. If one sinks, they both go down. By keeping your loans split, each property stays independent and you stay in control. Step 5, execute the strategy. We either refinance your existing loan to access further equity, or in some cases, we simply go to your current lender for a quick top up. At this point, the mechanics are in place, the numbers work, the structure's clean, and you're ready to move. But strategy isn't just about execution, it's about foresight. Here's the bottom line. Using equity isn't about pulling out the most money possible. It's about playing the game smart. Each lender has different policies, different valuations, and different servicing calculations. If you use each one strategically, you can keep pushing further ahead. It's like a big game of Tetris, lining up the right lender, the right property, and the right valuation at the right time. Play it well, and every move clears the way for the next. Play it badly and you box yourself in. The structure, lender choice, and repayment terms you set today will determine whether you can leverage more equity again in 6 months, 2 years, or at all. That's why having an investment specialist broker in your corner matters. We can leverage every single lender policy, every lender's valuation, all the different bank calculators and servicing numbers. We piece every little move together to put you further ahead than if you go down to the local bank branch and try to do it yourself. If you're serious about using equity to build wealth, don't go it alone. The cost of getting it wrong is too high, and the opportunity cost of not maximizing your position is even higher. If you'd like help structuring your equity strategy properly, you can find our details in the description below. Thanks for watching, and I'll see you in the next one.